Welcome to the week review of the markets from Hernandez Retirement Services. This is Agustin Hernandez. This week I will focus on the results of the S&P 500 index and the 10-year US Treasury Note. Last week on CNBC's halftime report, Double Line's Jeffrey Gundlach stated that the US stock markets were poised to go down since it would have to catch up with the international stock market's steep decline in 2018. I will review both indices next to each other to see if he has a point. I will also look at the strength of the S&P versus the 10-year US Treasury Note and see what it may be telling us. And finally, I will give you my opinion on what does this all mean. Before we begin the charts, the opinions voiced in this material are for general information only. All performance reference is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Technical analysis is the forecasting of future financial price movements based on an examination of past price movements and cannot predict the future. Technical charts reference are subjective. No strategy can ensure success or protect against loss. Investing involves risk including loss of principal. We start this week by looking at the S&P for the week ending 12/14. There was a lot of whipsaw action last week, but what matters is that the index fell below another 1.26%. In this chart, I am using the open high-low close bars for price. The bars in green are for positive weeks, while the red ones represent a negative week. I also put in the 10-week moving average in blue and the slower 40-week moving average, the black dotted line. As we can see from left to right in this 52-week window, the quicker blue line representing the 10-week moving average bounced around but stayed above the slower 40-week line until 3 weeks ago. That shows there is weakness in this index. Another troubling issue is ever since the first week of October, the index has had a hard time getting and staying above the longer-term moving average, which again shows signs of weakness. Another component to this weakness is that the weekly highs have been lower every time, so there is no strength when this market does try and rally. But there is one thing the index has not done in this pullback, and it has not broken the lows of the year, which were accomplished earlier in the year. Let's see if the S&P can use this low as a line of support and eventually bounce off of it for a new rally. This chart we will address the CBOT 10-year US Treasury Note. I am again using the same indicators we used with the S&P chart. Now, as I explained in last week's video, this asset has been in weakness over the last calendar year. It has shown on several occasions that it did not have the strength to get into a true uptrend. But in the last 2 weeks, it has done something it has not done in a while. It has now started and ended 2 weeks in a row above its 40-week moving average. Now, last week was a down week for the index. But the key here is that it still held strong to finish above its moving average. Another area now to keep an eye on will be both moving averages. One, let's start with the 40-week line. It has begun to flatten out, which is an early sign that the worst may be over for this asset. Next, let's look at the blue line. The quicker 10-week moving average is sloping up, but is still below the 40-week line. Now, it has done this in the summer without crossing above the long-term moving average. The key is whether it can now cross above it, a golden cross for this asset, which is a positive sign for the 10-year Treasury note, as the faster line would be above the slower 40-week line. So the keys for this is whether the 40-week line can begin to slope up and that price stays strong enough to get the 10-week line to cross above the slower moving average. But until that happens, it is still a suspect, not a prospect for a rally. In the intro of the video, I mentioned that Double Line's Jeffrey Gundlach has stated his views that the U.S. equity markets would go down further and catch up with the international stock markets. Well, let's look at the chart and see a comparison of the S&P in black and the developed international stock market in blue. As we can see from the last 52 weeks, the first half of the year, both indices moved pretty much in lockstep. But in July, we start to see the S&P move higher, while the international markets begin to roll over. And for the months up until September, there was a major divergence between these two indices. And this is where Mr. Gundlach's issue is with this chart. One or the other must be right, but which one is it? Mr. Gundlach sees the price of the international markets based on true weakness in their economies. And if this is truly a global economy, should not the US also begin to get weak? There still is a gap between these two markets, and whether they match up later, who knows? The key for us is that we do know both these markets are weak and below their respective 40-week moving averages. So that is troubling. Now, the final slide of the video is comparing the S&P in black against the US 10-year Treasury notes in blue. Looking at the S&P, we see a lot of choppiness in the beginning of the year. And it looks more so since we are using daily price action. But outside of a few weeks, the index had been above the zero line. The 10-year note, which we can see in blue, had been below the zero line all year, and outside of a few short times below the S&P. Now, something we have to look for is whether this is just a short-term issue between these two assets, or is this the beginning of the blue line staying on top? That will show that the S&P is in true weakness, while the 10-year Treasury note is being looked at as a place to park while this pullback finishes, or if we are in for a longer than expected negative market. As we saw in the previous chart of the 10-year note, it is trying to get into a new uptrend. The next few weeks should tell us more about this relationship. What does this mean? As stated in the previous videos, this US stock market has pulled back quite a bit and it can't get out of park. So the fear is that it may really intensify a new backwards movement. Will it join the international stock markets? Will all this be confirmed by the potential rise of the US Treasury note? We are getting close to where we may get confirmation that a true bear market may be in the offering for the US stock market, or if it will muster the strength to hold off its lows of the year and fight back. Will the Fed save or hurt the US stock markets? Next week will be a better gauge than a knee-jerk reaction this week. So if one is still in US equities, just be very cautious. There seems to be movement soon. The question will be, is it bullish or bearish? I would like to thank you for viewing this video and I hope it was helpful. Please subscribe to my channel for future videos.